So today we are going to be discussing about Chapter 9, which explains how to prepare flexible budgets and how to compare them to actual results for the purpose of computing revenue and spending variances. So the variance analysis cycle. The cycle begins with the preparation of performance reports in the accounting department. These reports highlight variances, which are differences between actual results and what should have occurred according to the budget. The variances raise questions such as, why did this variance occur? Why is this variance larger than it was last period? The significant variances are investigated to discover their root cause. Corrective actions are taken. Next period's operations are carried out and the process is repeated. So now we're going to take a look at preparing a planning budget and a flexible budget with one cost driver. So a planning budget is prepared before the period begins and is valid for only the planned level of activity. If the actual level of activity differs from what was planned, it would be misleading to evaluate performance by comparing actual costs to a static, unchanged planning budget. A flexible budget is an estimate of what revenues and costs should have been given the actual level of activity for the period. Flexible budgets may be prepared for any activity level in the relevant range, enable apple-to-apples cost comparisons, help managers control costs, and help evaluate managerial performance. So let's take a look at Larry's lawn service. So we will assume the following facts that with respect to Larry's lawn service. And we will note that Larry expects to mow 500 lawns during the month of June. So Larry's lawn service provides lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepares his June budget based on mowing 500 lawns. Since all the lawns are similar in size, Larry felt that the number of lawns mowed in the month would be the best way to measure overall activity in his business. So we'll assume that Larry prepared the planning budget for June as we see here. Notice that the budget includes two variable costs, that is, of gasoline and supplies, and equipment maintenance. So gasoline and supplies, those are lumped together, and equipment maintenance. Obviously, that's going to vary based upon how many lawns he's doing. Obviously, he's doing more lawns, he's going to use more gas. He's going to use more supplies, more trash bags, more line for his weed trimmer, and so on and so forth. And the same thing with the equipment maintenance. He has 4 fixed costs, which are his office and his shop utilities, his office and shop rent, equipment depreciation, and insurance. And he has a mixed cost, which is wages and salary, because part of that salary is going to be fixed. But obviously, if maybe he has somebody that works for him that he pays hourly, and so the more hours they work, then it would change. So now we have the actual results for the month of June. And we know that Larry, that he's mowed 550 lawns. So before he looked at this previously, he figured that he was going to mow 500 lawns, and he figured he was going to have a net income of 5,000 for the month. But because he ended up doing 50 more than what he planned, he had operating net income of 6,450. But let's go ahead and do some more comparison work here. So if Larry wanted to, he can compare his actual results to the planned budget as shown here. Notice that the variance in computing revenue and each expense item. So we have some items that have a U, which means that it was an unfavorable variance, meaning that he spent more than he budgeted. And then we have some items that were a favorable outcome, meaning that he spent less than what he figured. And of course, some things were fixed, and so they obviously didn't change. The actual results column and the planned budget column have apples and orange icons to emphasize that the amounts in both columns are for different levels of activity, 500 versus 550. Actually, I don't see that here, but just realize that what he was planning for was for one level of activity, but what he actually experienced was for another level of activity. So kind of keep that in mind as we look at this. Now, a favorable or unfavorable revenue variance occurs. So a favorable variance occurs when revenues are greater than the planned budget, and an unfavorable variance occurs when revenues are less than the planned budget. A favorable expense variance occurs when the actual expenses are less than what the planned budget was. Likewise, an unfavorable expense variance would occur if expenses were higher than budget. Now, the important question for us to consider is, do these expense variances indicate whether Larry has done a good job controlling his costs? That's what we're trying to figure out. Is he did have a couple areas that were unfavorable, primarily with his variable expenses. We want to know, okay, how well did he do in controlling that? So at this point, we cannot answer this question because the actual level of activity is greater than the planned level of activity. Therefore, actual variable costs are likely to be higher than the planned variable costs, regardless of Larry's managerial efficiency. So to intelligently evaluate Larry's performance, we need to determine how much of the cost variance was due to higher activity level and how much was due to Larry's ability to control costs. In other words, we need to flex the planning budget in order to accommodate the actual level of activity. And that's what we're going to take a look at now, is how do we adjust the planning budget in order to match then, so we can compare apples to apples how we did. Because remember, otherwise you're looking at different levels of activity and you can't compare those. So how a flexible activity budget works. Variable costs change in direct proportion to the change in activity, right? If you're doing, as I mentioned before, if you're doing more, then obviously then it's your costs, your variable costs are going to be more. Now, total fixed costs are going to remain unchanged within a relevant range. So he's still going to have, his office rent is still going to be the same regardless of how many lawns he mows, for example. So now let's look at a flexible budget for Larry's lawn service. So we'll notice that Larry's flexible budget for an activity level of 550 lawns mowed is shown on this slide. The Q in all the revenues and cost formulas is 550 lawns mowed. So the Q is for the times the quantity. So that's what that means. So if we look at this, we see that the revenue of 41,250 is computed by multiplying 75 by 550, because he gets paid $75 for each lawn that he mows during the month. And a wages and salary expense of 21,500 is computed by multiplying 30 by 550 plus 5,000 in fixed salary. So it might be for his salary, he gets 5,000, and then his workers get $30 for each lawn that they mow. So we can calculate that, multiply that out. Now, the fixed costs in Larry's flexible budget are not sensitive to changes, so we just carry them over. So again, his office and his shop rent is going to be the same. His equipment depreciation is going to be the same. His cost of insurance is going to be the same. Those things don't change. So now, what would be the total wages and salaries based on if he did 600 lawns? So again, we can take the $30 per lawn times 6,000, which is 18,000, and then add the salary, which is 5 to it, gets us 23,000. All right. So now we'll look at calculating and interpreting activity variances. And an activity variance arises solely due to the difference in the actual level of activity and the level of activity that is included in the planning budget. So now what we'll look at is we'll use the flexible budget concepts in order to compute the activity variances for Larry's lawn service. Now, the level of activity in the flexible budget, 550 lawns, is 10% higher than the level of activity for the planned budget, which is 10%, which is 500 lawns, excuse me. The revenue in the flexible budget is 10% higher than the planned budget because the revenue varies proportionally to the change in the activity level. The variable costs in a flexible budget, gasoline and supplies, and then also equipment maintenance, are 10% higher than the planned budget because variable costs vary also proportionally to changes in the activity level. The mixed cost, which is wages and salary in the flexible budget, is less than 10% higher because the planned budget because the fixed cost components of the mixed cost do not change when the amount activity level changes. So the salary portion doesn't change, only the wage portion does for our wages and salary. And then the fixed costs, again, are going to be the same as the planned budget because they do not change in response to changes in activity level within the relevant range. Now, the net operating income in the flexible budget is more than 10% higher because than the planning budget due to the presence of the fixed costs, because those again aren't going to change. So you see that. So it's more than 10%. Now, the next section is to interpret and calculate revenue and spending variances. So key terminology. A revenue variance is the difference between the actual total revenue and what the total revenue should have been given the actual level of activity for the period. And then the spending variance is the difference between the actual amount of a cost and how much the cost should have been given the actual level of activity. So now we'll look at computing revenue and spending variances for Larry's lawn service. So the revenue and spending variances for Larry's lawn service would be computed as shown here on the screen. And I don't see Apple icons, but anyway, indicate that the actual results and the flexible budget columns are both based on 5. Just know that, and we can see that the number of lawns for both are 550. Okay. So we see that the 1,750 favorable revenue variance indicates that the actual revenue exceeded the budgeted amount that would have been expected if he did 550 lawns. So the revenue was higher than what what the budget said that it was going to be. Now, the 1,950 unfavorable spending variance indicates that total expenses were 1,950 greater than what would be expected for the activity level of 550 lawns mowed. The overall net income was $200 less than what was expected for the activity level of 550 lawns mowed. And then we'll prepare a performance report that combines activity variance and spending and revenue variances. So we'll look at that. So, okay. Okay, this slide contains the previously computed activity, revenue, and spending variances. Notice that the variances appear between the amounts being compared rather than after them. The more specifically, the activity variance appears between the flexible budget and the planning budget. And the revenue and spending variances occur between the actual results and the flexible budget columns. The activity variance can be computed by taking the difference between the flexible and planning budget columns, or by taking the difference in activity level between the two columns and multiplying it by the variable rates shown in the revenue/cost formulas. For example, the revenue activity variance of 3,750 favorable can be computed by multiplying 50 lawns by $75 a lawn. The wages and salaries activity variance of 1,500 unfavorable can be computed by multiplying 50 lawns by $30 per lawn. The revenue and spending variances are computed by comparing the actual amounts and the flexible budget amounts. For example, the revenue variance of 1,750 favorable is computed by taking the difference between the actual amount, which is 43,000, and a flexible budget amount, which is 41,250. When interpreting a flexible budget performance report, it is important to remember two things. First, to generate a favorable activity, variance of net operating income, managers must take actions to increase the level of activity. Second, to generate an overall favorable revenue and spending variance, managers must take actions to protect selling prices, increase operating efficiency, and reduce the price of inputs. Then we'll take a look at how this works for a nonprofit organization. Okay. So the performance reports for a nonprofit organization differ from our examples in one important respect. Nonprofit organizations usually receive funding from sources other than sales. For example, universities receive their funding from sales, which would be tuition that was charged to students, endowment income, donations, and if it's a public university or college, also state appropriations, right? So for example, Merced College, we get money from the state that helps to pay for a lot of the things that we do. Obviously, we do charge tuition and that, but a lot of it does come from the state. You have colleges like where I went to school that was private. They didn't receive any funding like that from the state. The only funding that they would have received from the state and the feds was basically from sales or from tuition and fees. What they got paid for financial aid, what the financial aid the students received. So this means that, like costs, a university's revenues would also consist of fixed and variable elements. Performance reports are often prepared for cost centers. These reports should be prepared using the same principles discussed so far, except for the fact that these reports will not contain revenue and net operating income variances. So now we'll look at preparing a flexible budget with more than one cost driver. So more than one cost driver may be needed to adequately explain all of the costs in an organization. The cost formulas used to prepare a flexible budget can be adjusted to recognize multiple cost drivers. So let's assume that Larry determined that wages and salaries were driven by the number of lawns mowed and the number of hours that were required for additional edging and trimming. And so because of the time required for edging and trimming is different for different lawns, Larry has decided to add an additional cost driver, which are the hours for the time that was required for edging and trimming. So Larry estimated the additional hours and developed a new planning and flexible budget that includes the second cost driver in both his revenue and expense budgets. Okay, so Larry's flexible and planning budget could easily be adjusted to accommodate a second cost driver. Notice that the number of hours, or H, is designated as the second cost driver. Larry's flexible budget is based on 100 hours of edging and trimming. The cost formula for wages and salary has been adjusted to include $25 per hour for edging and trimming. And Larry has adjusted the revenue formula to include $25 per hour of edging and trimming. And then we'll look at preparing a performance report for more than one cost driver that combines activity variance and revenue and spending variance. So the performance report from slide 31 has been redone to include the additional cost driver. So we can see that how everything then would take into account. So I'll leave this up for a minute just so you can look at it. Or you can go ahead and pause the video. All right, and so that's it. Go ahead and continue working on the rest of the assignments, including the discussions. Please be sure that you are going back in and that you are replying to 2 students as well to make sure that you can get your full points. Also remember that for the quizzes and the problems, you can go back in and retake them again if needed, and the highest score remains, as well as for the final exam, that if you didn't do, or not the final, but the midterm, if you didn't do well, you can go back and attempt it again. Because I realize sometimes things happen with the computer or different things, so I want to make sure you can do your best.